Greetings, Dr. Jeffrey Scott. This is my weekend market update for the week ending Sunday, December 18th, 2022. Markets sell off from obvious resistance. Anybody that watches me on a regular basis or my daily videos on stocks and docs.com should have known what was coming. Unfortunately, it was pretty obvious, but doesn't mean it doesn't ultimately hurt some people. My email address is hgsidoc@gmail.com. I welcome any remarks on the YouTube channel or emails directly. This is for education only. Anything I talk about should be considered education and not investment advice. I am a doctor, not a broker. That means I have none of the Series 7, 9s, whatever the numbers are that I would have to actually give you investment advice. I'm independent. Anything that I use, I've paid for. It's the same tools I use in my daily trading. Trading involves risk. You alone are solely responsible for any investment decisions you make. Probably won't talk about specific option trades today, but I do trade mostly options. They are considered risky. You should always consult your investment advisors and trusted sources like the Options Industry Council before trading them. If you like the things that I say, I welcome you to join me at the Wealth 365 event. It is occurring the week of the 16th of January, so that puts it about a month from now. I will be presenting once or twice. I haven't got my calendar yet, and somewhere below the video you'll see the link with some of the other links I provide. If you'd like to sign up, it would really be great if you signed up with my ID here. Stocks are cyclical. I talked about this last week as well. It sure feels to me like we are entering another leg down. Now, I know the seasonality. I know we got Santa coming. I know that is possible. But if I was a betting man, and I'm not, I would think the likely direction from here is lower. That said, we actually are getting a little bit oversold short term. I'll show you the buckets as an example of that. And maybe we get a little bit of a respite rally and then we roll over. Probably not a time to be a hero to the long side if and when we get a rally, because I do think, and we'll talk more about it during this video, we're going lower. Major markets tell the story. You can see over the last 5 days the things that were up, and were up modestly: the VIX, commodities, treasuries, oil, and natural gas. Not exactly what you'd expect if you're a rip-roaring bull on equities. The other thing that I think is important is to remember that we're still way up the October lows, almost 15% on the Dow, 13% on the NYSE, 10% on the Spiders, 7.3 on the Russell, and around 6.1 to 7.9 on the NASDAQ. What that tells me is to go back and revisit those levels short term would not be a surprise, and that gives you a sense of the magnitude. When you look at where we are from the beginning of the year, the dollar leads. The Dow's only down 11, but that's worse than it's been. Nearly 14 on the NYSE, 20 on the Spiders, so back in bear market territory, and over 30 on the Qs and 23 on the Russell. Just gives you an idea of how rough it is out there and why any bullish strategies from me or anybody else right now have a lot of hopium in there, and I'm not sure that that's where the market's going. If we look at the ETFs, you can see the leaders to the downside remain communication, discretionary. The one that I expect to do better now might be real estate because it's defensive, but perhaps because of the interest rate sensitivity. But it is up 13% off of its lows back in November. Other things to watch in the setting of this current market are utilities, staples, and perhaps healthcare, which is over the year only down 5.5%. Now, you have to ask yourself, why are rates falling when the Fed is rising or raising them? And to me, it sounds like that's occurring because somebody doesn't think the economy is as strong as the Fed does. Now, they always say don't fight the Fed. And I think until the Fed recognizes that or does something about it, the pressure will be to the downside. But with the falling rates, I think maybe the economy and the market is telling us that it's not what the Fed thinks. Is there a recession in our near future? On the left, you see the credit spread showing you whether money is becoming tougher. Credit is becoming tougher. And if you go back to this spike over here, which was the end of 2018 to 2019, there was a nice market sell-off. If you look at 2020, when this credit became tight, market sell-off. Well, we've been tight for some time. So to me, I think a sell-off, recession are coming. On the right, you have the 10 versus the 2, and we've been inverted in the yield curve for over half the year. And I've looked back, and when we have this degree of an inversion, every time there's a recession, the recession doesn't occur when you're inverted. It occurs after the inversion is resolved. So that's the future. Now, breadth per se isn't bad, but it's come down considerably. Stocks above the 200, stocks above the 40. And if you look at the 21-21, 13-week new high, new lows, it has rocketed down. Now, when we get down to the bottom, it usually says we're oversold and the market's likely to go up. When we start to peak, the market's overbought, the market's likely to go down. So we're not quite at a point where you'd expect a reversal, but maybe we're getting within a couple of days. Again, I don't expect any rally that we see to be anything more than perhaps a little short covering, a little repositioning, and an opportunity ultimately to short from higher prices. The buckets takes all the stocks in the S&P 1500, applies a Bollinger Band to them, and asks the question, one, how many are above or below the midline? In a bull market, you'll have half the stocks or more. In a really strong bull, 80% or more will be above the midline. And in a bear market, it's the opposite. And then if you take 0 to 100, 100 being the upper band, 0 being the lower, break it into 10 deciles, where do the stocks reside? We call those buckets. Then you got a bucket above and a bucket below. And since 95% of the time stocks are going to remain within their Bollinger Bands, when you start to see a collection above or below, that should tell you something as well. And what I'm looking at here shows me that over 25% of the stocks in the S&P 1500 at the end of the day on Friday were trading below the lower Bollinger Band. This is where the short term tells me that we could see something this week with a little bit of a reversion rally. I just don't think it's a big rally. I'll also tell you in bear markets, especially in a recession, they can get a whole lot worse. 86 below, over 25 below the bands. That is not a pretty picture. And you could see it's weakened both stocks below the midline of the Bollinger Band and the number of stocks underneath the band over the last week. I would not expect a Hindenburg omen signal to fire until we have some type of at least nominal new highs. And we don't have one this week. But what is important to me is the preponderance of new lows here in pink versus new highs in green over the last several days. And when I see that, I expect to see further movement to the downside. Now, here is sort of my look at the market on the week. And for the most part, you could see that the average stock was down about 2%. Now, this looks like it's picking up here in the higher ERG or the higher growth related names. But there's not a lot of stocks there that are included. But you can see here that higher relative strength, here's the performance on the week, outperformed. And interestingly, those groups that enter the week stronger than other groups actually outperformed on the week. So um, I guess that it should give you a little bit of a bullish feeling for high growth, maybe just a teeny weeny bit, but certainly not very much. So I'll take away the word bullish. How about maybe give you a little bit more neutral? Now, these are from my favorite Q Edge tools, and these give me a real time in the market by buckets and a few other things. So let's start up here. Notice how deterioration of stocks below the Bollinger Bands went from Thursday to Friday. So similar number to the Edge Rater, but this is done real time, very few stocks up at the top. And then the other thing, it told me that on Friday, all the sectors were down, 88% of the industry groups were down, and 76% of the stocks were down. Now, how do you make money to the long side in that scenario? Now, even though the week started out strong, still only one sector was up on the week. 87% of industries were down, and on the week, 79% of stocks were down. So if you had a positive week, that's something special, because for the most part, it was a negative week in the markets. Once again, news and earnings are likely to drive what we see in the markets. And on the news front, I was surprised to not see more Fed heads pop up. And either I didn't capture them on this report, or perhaps they're on vacation for the holidays. But we got some jobless and we get numbers, and on Friday we've got the PCE, which is something that we know that the Fed likes to watch. From an earnings perspective, as we go into the holiday season, no surprise, the number of stocks having earnings has dropped. FedEx might give us some insight into holiday shopping and shipping thus far. And as I put in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. And it's bad judgment to not know when your stock's earnings date is scheduled. Now, I was going to title this week, All That Glitters is AG, thinking of silver, but also thinking of agriculture. And one of the names whose chart actually looks pretty good is CalAmp. Have to make sure that's the right one I'm thinking of. Maybe it's CalMaine, so I might be wrong on that. But CalMaine is a agriculture company. I think CalAmp might be technology, so I'm going to hold what I was going to say. But ag did look pretty strong, and that's something that we might want to keep our eyes on. So what are my thoughts? Markets rose early in the week on some merger news, Coupa, Horizon Pharmaceuticals, and bullish expectations on the Fed and the CPI. Tuesday was eye-opening. We gapped up 2% of the open or more, including 3.8% gap on the NASDAQ. And by the way, the futures gapped up a lot more than the indexes did. They had already given up some of the strength before the 9:30 hour. The fact that we saw a high volume reversal probably told us a big story. Wednesday, strength again early. I guess some people thought the Fed might be dovish, but when the announcement came out, the market traded lower, and during the press conference, it got even further lower. Rest of the week, I think, digestion of the CPI and Fed statement, concern about longer rates up, longer duration, and slowing economy, recession, the market sold off. Now, the funny thing is, Powell made a big deal of talking about how the Fed sees tightening going longer than the market seemed to. You notice they didn't say that the Fed had predicted the rates right now would be 1%, and that they have notoriously long. So I'm in the camp that we've got a recession, and I'm in the camp that they start cutting next year, maybe earlier than people think. Most bear markets don't end to Fed cuts. And lastly, and I'm going to show you two charts on these last 2 points, bear markets and recessions are much worse and would not be unexpected to see a further 20 to 30% drop from here. So on the left is something published months ago by Bank of America Global Research. It's through August of 2022. And the point it's making is these blue lines are the market bottom. And notice the market bottom doesn't occur when rates are rising. Market bottoms occur after rate cuts. So until you see a rate cut, perhaps there's not a lot of reason to expect that you're going to see a market bottom. On the right, this is from NDR Research, you can see in black sort of outlines the secular bull market recession. So overall, you're in a bull market and you're in a recession. You're not in a recession, rather, and you're in a bear market. And you could see where we're at right here for the Dow is a very typical bear market within a secular bull. Over here, which is a considerably bigger drawdown, is kind of the typical bear market in a secular bear. Excuse me, within a secular bear market. So if we go into a recession, then we might expect the bear market to be significantly worse than what we're seeing today, meaning potentially for another 20 or 30% down. I probably confused you there. The bottom line is, if we go into recession, we're probably in a secular bear, and inside a secular bear, bear markets are much worse. Don't fight the Fed is the real answer. Again, if you like the things I talk about, I invite you to come to the Wealth 365 event. I'll be speaking, reviewing the market. Somehow I'm becoming Mr. Bear when I used to be Mr. Permabull, but I think it's just reality. And there's lots of other speakers, lots of other great free information and opportunities to pick up wealth charts and other add-ins at a significant lower price at other times of the year. So let's go look at some charts. Now, just want to call out, we just finished our live meeting in New York. Attendance was light, but I think you had a bear market and still some COVID fears. I'm thinking of 2 meetings in 2023, one in the West Coast in the first half of the year, and then the back half back here in Florida. More to follow. So let me kill that. All right, so before I jump into wealth charts, I do use a number of programs, and I think that's okay. And I think that most people use more than one program. I just want to jump into HGSI for a second and to show you how weak this market is. In HGSI, www.highgrowstock.com, there are 175 different industry groups. 174, maybe I think one might be an index. If I look at 2-day force up, I've got 4 groups up. So I guess if you're looking for a reversal, that's almost unheard of. That's really, really low. Typically, and I think 2 weeks ago we had 80. Last Sunday it was probably in the 40s or 50s. Now what surprised me, if I look longer term, 5-day up, I've only got 3. So I've got very few industry groups that are in bullish posture, either very short term or long term. And if I look at the 2-day force down, I've only got 7. Now, how do you put that together? Because once you move into the 5-day down, you pretty much come out of the 2-day down unless you're brand new. And on the 2-day down are some things with recent strength. Marine shipping, think Scorpio tankers. Real estate services, coal operators, BTU, CEIX, marine shipping, STNG, entertainment facilities, expiration, and then home builders. Where are all the industry groups residing? They're residing in long-term down with 89% showing a fairly, what's the word I want to use, a fairly persistent downtrend. So if you think this is a great market to go fishing from a top down or bottoms up for bullish trades, you're a much better trader than I will ever be. Now the other thing I want to look at is, people know I like to use the expected moves to see, where we're going this week, what's predicted, and what happened in the prior week. So the first thing you'll notice, the expected move is down. All right. You'll notice that you have a gray line, which is the close of the prior week, and then you have a green line, which is the movement of a call and a put, the premiums combined to the upside, or the combined premiums to the downside to the red side. So that would be a straddle at the money at the gray bar. So it looks to me like the projection is the market goes lower here, and that's probably tied to where it closed. Now, if we look at what happened last week, I would hate to have been the market makers on Tuesday, and they ended up really doing well. Why? Because the market makers sell the option as long as it finishes, or sell the straddle, and as long as it finishes between the red and green, they make money. Well, look at Monday, we opened up and finished above the green line. Very strong move. Tuesday, massive move and a reversal. Wednesday, Thursday, Friday, we sold off. The S&P finished above the red line. The NASDAQ above the red line. The Dow above the red line. And the Russell above the red line. So the market makers did pretty darn good. The VIX, looking here at the VXX, was up on Friday, but finished right below the midline, and the dollar, which traded below the midline, got back in there. So this gives me a sense of what each day looked like from a very macro perspective. Now let's jump into wealth charts, and one of the things I like to do is once I open it is hit the F11 key and it gets bigger. So let's look at the spider 5 minutes and take a look at the last couple of days. These were some interesting days, and the first thing you should notice is the trend here is down. So I'm looking for, this must be Tuesday, major gap up, all right, and then the market sold off the rest of the day. Wednesday open was kind of a little move up, and then into the Fed number, a sell-off. And then from that point on, Thursday Thursday is here with a gap down and a sell off the rest of the day. Friday, gap down and sell off the rest of the day. Not a very bullish week in the market. Now, the obvious resistance, which goes back, and for those that watch my dailies on stocksanddocs.com, you've seen this every day, is this is a pretty clear-cut resistance that goes back to the peak at the end of 2021, the beginning of 2022. And what you see is from that date, the market has just consistently sold off. And this trend line has really become almost a, what's the word I want to use? Not wet noodle, but a wet blanket sitting on top of the market. And it continues to be resistance in January, in March, in August, early December, and then here's that crazy day on Tuesday of which we broke above it, could have started celebrating, but I'm always reminded it's where we closed, not where we open. And we broke down off of, or failed at that trend line resistance, which is also where the 200 is. Now, where do we go from here? Good question. Right here is the June lows. I probably should put in the line there, which is, I think I will put that line in. Get to a horizontal line, and let's take that line down to here. And this is the October lows. And so now we got a couple things. We got the June low, got the October low, and then this is the highs of the 2020 before the market rolled over. My target, since I blew right through the 50, which was support, is probably to come down somewhere close to the June or October lows. That's a considerable drop from here and probably an opportune shorting time. Obviously, the time to short was the failure of the trend line. However, as I pointed out, you might get a little bit of a rally because of oversold and then a better time to short. And that's what I'm going to be looking for. Now we can look at all the markets the same way. On the daily, the Qs failing just below resistance, breaking support of the 50. The diamonds, which have been the king diamond, not so much anymore, has broken now below their trend line. Still above their 200, but barely. If they don't get back above that trend line quickly, I think we just had a failed breakout. And if you think about the Russell and its failed breakout from the Darvas box in 2021, it did not end well. So that failed breakout is worrisome. If we look at the Russell, very similar to the Dow and the spiders, because it actually broke above and failed on the 200. Tried again on Tuesday. It's broken down below the 50, and the June and then the October lows look pretty obvious to me on the Russell. Just put the horizontal line here, bring it down here to those October lows. So you're really at a point where the highs from the pre-2020 correction and the October lows are almost superlapping, and that might be where we end up. And I believe these here are the are those the June lows? Probably not. Those go all the way back to the May lows. So is this my target here? 162, 163? Could be. These markets are not looking pretty. The VIX, why is the VIX not going up? I think part of it is there was a lot of volatility going into last week. And so despite the fact that the market is at best scary, and at worst pretty horrible, I think what's happening here, if I had to guess, is that a lot of volatility came out with the Fed and the CPI. But I would not be surprised to see volatility continue. And the VXX was up 5.5 on Thursday and another little bit on Friday. So it's not like it's ignoring this. The dollar broke below the 200, which would be awesome. And then it's battled up. And this line's important. It's a line that I put in this week during my Stocks and Docs videos. And why it's important is it was support back here in August, but it was resistance back here. And this is likely to be a strong line. If the dollar can hold here, then I think the dollar is going to go higher, and that's not great for the bulls. If I look at my commodity list, dollar supporting, you're going to get some stuttering here of gold right below the 200. Silver, which is actually better than gold right now. They both had okay days on Friday, but I like silver better. Oil's kind of stumbling around here. And natural gas, which is well off its highs, is bouncing. But we'll see how far it goes. It's probably related to what goes on within Europe and Ukraine and Russia as much as anything else. 10 years, we already showed you, has come off of its highs. Now, a lot of people ask me about my weekly timing model. And remember, I require two things to be bullish, and that would be price above the 30 WMA on the weekly chart, and then the weekly bongo to be green. Notice on everything here except for the diamonds, we've lost the weekly bongo and we've lost the WMA. So in fact, with both of those, I would say for my model, the spiders, the Qs, and the Russell have now generated a sell signal, while the diamond is still holding on, and we'll have to see what happens. When I look at how the market, we look at the market theme, one's expectation in this time of concern is large caps and value would be leading. They are, think, defensive. If we looked at sectors on an hourly basis, materials have been strong. Communications, despite some improvement in Meta, have been weak. Energy has sold off of recent. Financials sold off. Industrials, another one that looks like strength. Technologies come off the highs. You'd expect staples to be up there and utilities. Staples leading, utilities lagging. And we'll see if real estate turns around. You also see some strength versus the S&P in healthcare. Now, I'm going to start with the bull scanners, but I'm not feeling very bullish. And I hope you're not either because, well, first of all, this is not a market to be all in to the bullish or the bearish side. At least not yet on the bearish side, in my opinion. Could be soon, and maybe it is already, and I'm just late. But certainly on the bullish side, there's not a lot to love. If we look at a heat map of the S&P 500 on Friday, I mentioned some strength in Meta. You know, every time you hear somebody say we're taking down TikTok, think, ooh, that's good for Meta. And they're taking down TikTok. Netflix had a rough week. It's in a period of strong seasonality. Actually finished up a teeny bit on Friday. You know, when you look at Netflix, and when I was at my meeting, I talked about its seasonality. I mentioned it last week on my video. I hate to tell you to go buy Netflix right now because I just don't trust this market. But when I had my meeting, Netflix was up here. And I made a comment, I'd rather buy it down on this trend line. Well, maybe I got my wish. And so it's still too early for a seasonality play because you don't know where it's going to be going in to the seasonality. But you've got a trend line in here, probably short-term trend line. And you've got another one right in here. Let me get you know, I don't know. Maybe I'm overseeing it, but if I can buy it off this white trend line, if it takes it out and goes back above it, I might look whether or not I want to start building a position for Netflix. And I'll just look at it. It's probably still sitting here from last week. Let me adjust some of my things a little bit. And I got to push it up, advance it a week because we're going into here. If you look at, this is, you know, the week is set on the 13th, so I guess I could go forward to the 20th. If we look at this period of time between the 20th of December, which will be middle of the week, and the end of January, you'll see Netflix has been up 8 out of 10 years, average return 13.45, and if you took out January, it will look a lot better. Here's the 10 and 15-year seasonality prediction is very strong. And if you look at what we saw, for example, in 2021, we saw the move occurred actually early. If you go back in here in December. So it's time to start thinking about it. I just get nervous, and that's why I'm thinking about it. I'm not saying I'm doing it because the market is so weak. CAT scanner, put it on the, let's go to Wealth Scanner real quickly. Part of a weak market is you don't expect a lot of things to have an 800. I'm looking at my major market ETFs, and nothing's above 700, and the leading entity is SARK, which is a contra ETF that goes up when ARKK goes down. And what's ARKK besides Kathy Wood's mess? It is a bunch of small cap growth with Tesla also included. What's leading? Anti-ARCs, housing, which is falling, bonds, which is falling, bearish dollar, which is falling, China. So, you know, hard to see anything to like in there. And just for purpose of completeness, let's just look at my weekly combo leader list and look at a couple things that come up. Adobe comes up to the top. Now, software names firm some, and Adobe is a great company, so I'm cool with that. I have to go back and figure out what those lines are. They're old. But what I wanted to talk about is Adobe had some good earnings, good forward numbers, good volume, breakout, momentum and volume, relative strength and OBV turning up. Why do I not like Adobe? It's got tons of overhead supply, and I think the market itself is at risk. Exact Science is a pure news play. One of its competitors in the colon cancer screening, Guardant Health, had data come out about a blood test to tell you if you have colon cancer versus Exact Science, where you can skip the colonoscopy if you have reasons medically or refuse to have one, and they can look for evidence of cancer in your stool. Neither are replacements, in my opinion, as a physician and a cancer doctor for the colonoscopy, but Guardant's data, although it may lead to an approval for them for the test, was not as strong as Exact, and Exact had a big rebound. They lost some of the gap up, still finished high. I'll put this on my watch list if this market shows strength. 8KRO, I don't know if there's a takeout of this. I don't think so, but this one looks like it wants to go higher. And what a great day, up 6.5% on volume, breakout, and momentum in the setting of a bad market. So I'll be watching that one. So it's interesting, just by running my scan, some of the better looking stocks come up. I mentioned Calm. Check when their earnings are out, but Cal-Maine Food is an agricultural play, and again, massive volume, breakout momentum, improvement relative strength and OBV. And then the last one I'm going to look at right here, I'll look at one other. This is, I have no idea what's going on here, but it showed up on a bunch of my scans. It's a relatively young oil play, and it certainly had been beat up, but look at the massive volume, the big move up, relative strength OBV. I'd want to know more about, actually I thought it was energy, it's Cosmos Health. I guess there's a KOSMOS in energy. I might want to do some research because that's a pretty incredible move. And the last one I want to look at here is MAG. And I mentioned that's AG silver and as well as agriculture. And here's a big volume breakout, 3 dots, relative strength and OBV in the silver arena. Nothing I love, some things that are interesting. Be very careful in this market. Now, if we look over at the bears and we start with the wealth scanner, let's see if anything comes up high. And what we see is regional banks are bad. IBD 50, small cap growth are bad. I mean, again, in the bearish scans, what comes to the top are the things that are doing poorly. All right. IBD 50 is bad. Just think about this. How do you make money buying the IBD 50 stocks in 2022? Look at this run from November of 21 at 52 down to 22. Now, do I think that something has happened to the people at investors.com? No, these are great stock pickers. It's based on O'Neill's system, which is a foundation of what many of us do. And it's just small cap growth doesn't work in a bear market. That's what it tells me. Well, is there anything working? So I'll do the CAT scanner in reverse. I'm looking at my weekend short review. So it's a bottoms or top-down list of the bottom stocks and industry groups. And Avalon Bay is an apartment company REIT. It's expensive. Now, the challenge on the short side here is that we've already fallen quite a bit. However, we have certain things we like to look for, and a failure at the 50 with an EMS signal on volume, weakening of OBV and relative strength, 3 dots coming out of a squeeze. That's interesting. Crown Castle, another REIT, and I guess some of these probably require financing and maybe the higher rates. Again, failing at the 50, I want to make sure there's a clear breakdown. Um, there are a lot of stocks on this list. PSA was one that I saw that I thought looked interesting, an expensive stock. I guess if you can't afford your rent, the first thing you do is you cancel your storage place and you move your junk back into your garage. And this is one that's probably a lifestyle play down here in South Florida. And if people are going to get tight because we're going into recession, are these guys going to get hurt? Again, volume, breakdown below the 50, 3 red dots. So there are plenty of things here. SBAC, now they require investment dollars and interest-bearing vehicles because they're building out communication infrastructure. A breakdown below the 50 here, which again I'd wait till it breaks, closes, and more importantly a retest and failure. But that's another one that's setting up. Now, people that have been here before know that one way to play a market drop is to start looking at things like the contra ETFs. And there are a number of contra ETFs that might be interesting should this market continue to break down. So I'll just review them again. If you are thinking of shorting the Dow, one way to play it is DOG, and this will go up as the Dow falls. Clear uptrend, overhead supply, resistance from the moving averages, which means if I look at the Dow, it'll be the opposite where it's got potential support from the moving averages. So a break below this on the Dow is likely to lead to a breakout above these. If you think the place to go short is the Qs, all right, technology, this is the SQQQ. It will go up when the Qs go down. Get above that 50, coming out of a squeeze, strong relative strength in OBV. How about small caps? You can look at the TZA, and this will go up when the IWN is falling. Again, all of these, if you go back and I look at my indexes, we've got resistance, or excuse me, support potentially coming in around here on the IWM, which is why I'd rather see how this market moves before I start loading up on these. And I've got some a little bit resistance here. So I think it's okay to wait and see where it goes. You'll have plenty of time to make money to the long side on these if the markets sell off. Now, some people think tech is the way to go. So there's one TECS, tech, which was a big leader in the bull market. It turns out there is a leveraged ETF that allows you to short technology with a long instrument, and you could see TECS, which really came down hard since the last run up since the October lows, but got up to 62, and now it's nibbling at 38, and it's already come off its lows. So there are ways, to play. How about the S&P 500? You have the SDS, which is a ProShare Ultra Short, and I think I misspoke last time. I think this might be 2X, but you could see it's about to break above the 50, and if you look at the spiders, you'll see the spiders have just broken down below the 50. So this one might be setting up, whoops, wrong one to look at, for a big run here. And then, here's a list. If you don't like ARKK and you want to short Cathie Wood, there's SARK. So let me summarize my thoughts here, and then I'm going to say goodbye. This is a dangerous market. We are getting short-term oversold, all right? And that would not shock me to see the markets turn up a bit, okay? We've got Santa Claus coming. That would not shock me to see the markets turn up. Oversold, okay? Oversold. But we also have a Fed that's continuing to tighten in the setting of a potential recession, either here or coming. And I think longer term, as we pointed out here, this market goes lower. So what's my game plan? And remember, this is Jeffrey Scott, cancer doctor, entrepreneur and not an investment advisor. My personal game plan is to sit on cash. I've got some plays to the long side that are very small, that have minimal risk in them, and I've continued to take them off more and more every day. I will look to enter when I think the market is ready to go down those contra ETFs. So last comment is please sign up for the Wealth Charts or the Wealth 365 event, and have an awesome rest of the weekend. And a big shout out to my wife of 37 years. Blind date, proposal in 2 days, 37 years of marriage. She turned 62 yesterday. Happy birthday, baby. And still looks like she's in her early 40s.